If you're using hard money for rehab or construction projects, there's one detail that could cost you thousands, and most investors don't even think to ask about it. It's called Dutch versus non Dutch interest. I funded millions in hard money loans for hundreds of real estate investors, and this is one of the most misunderstood parts of private lending. So today, I'm going to break it down clearly so you understand exactly what you're signing up for. Let's start with the basics. Dutch interest means you pay interest on the entire loan amount, including your rehab funds, even if you haven't drawn those rehab funds out yet. Some lenders call this full boat interest. Let's say your total loan is 300,000, 200,000 for the purchase, 100,000 for your rehab. With Dutch interest, you're paying interest on that full 300,000 from day one, even though that $100,000 rehab budget is still sitting in a separate escrow account not being used yet. You're paying interest on money you haven't received yet. What is non-Dutch or as dispersed interest? Non-Dutch interest, also called as dispersed interest, means you only pay interest on funds that have actually been released. So if you've drawn 40,000 out of your $100,000 rehab budget, you're paying interest on $200,000 of the purchase plus 40,000 of your rehab. This structure obviously saves you money, and today most rehab and construction loans are structured this way because investors prefer it and lenders have to stay competitive. Why would a lender use Dutch interest? From a lender's perspective, Dutch interest protects the capital. If I allocate $100,000 to your rehab budget, that money is earmarked for your deal. If you later decide to self-fund your rehab and never draw those funds, that capital may have been sitting idle. Some lenders stopped offering non-Dutch structures because too many borrowers never used their rehab allocations. So while non-Dutch saves you money, Dutch interest protects the lender's expected return. So why could Dutch interest actually be safer? Now, here's where most people don't think this through. With Dutch interest loans, many lenders, including myself on certain structures, use third-party fund control companies. Here's how that works. At closing, rehab funds go into a separate escrow. A third-party company manages the inspections. When you complete the phase of construction, they verify it, then the funds are released directly to you. Because that money is sitting in a separate escrow, it is reserved specifically for your project. You have the assurance that the funds are there when you need them. Now, let me be clear. It's rare for professional lenders to fail funding draws, but it has happened in the industry. There has been cases where lenders ran into liquidity issues, couldn't fund construction draws, or mismanaged capital. This isn't common, but it's real. When I structure loans, I make sure capital is managed properly so draws are funded when they're supposed to be. And if you're working on rehab or construction deals and want clarity on how we structure our interest, you can click the first link in the description and connect with me directly. So when is Dutch interest required? In certain jurisdictions and lending structures, escrow and fund control might be legally required. That means Dutch interest has to be part of the structure. The purpose of those regulations is to protect investors even though it increases financing costs. So sometimes Dutch isn't optional, it's mandatory. What should you ask before closing or proceeding with a lender? Before you sign any term sheet, ask, is this Dutch or non-Dutch interest? Are rehab funds held in an escrow account? Are there third-party fund controls involved? How many draws get processed? And what happens if I don't use the full rehab budget? If the loan is Dutch interest, that is something that you're going to have to consider on how it affects your end of the day profit. So some final thoughts here are that most investors prefer non-Dutch because it lowers interest costs. But Dutch interest can offer additional structural security when escrow and fund control are properly used. Neither structure is automatically right or wrong. What matters is how the lender manages liquidity, how draws are handled, and whether the terms are transparent. I funded millions in hard money loans for hundreds of investors, both non-Dutch and Dutch structures, and having this conversation with your lender could help you save thousands of dollars and protect your project. If you're evaluating a rehab or construction deal and want to know how we would structure it, click the first link in the description and reach out to us directly. Understanding this detail could save you serious money and some serious stress. And I'll see you in the next video.